The S&P 500 dropped 8% in 3 days back in February. Nvidia lost $300 billion in market cap in a single session. Michael Burry closed his fund and started screaming about AI infrastructure being the next mortgage crisis. Your portfolio is probably down 15, maybe 20% from its January peak, and every finance YouTuber is telling you to sell everything and hide in treasury bills. Here's what nobody's saying. The average investor who panicked during the DeepSeek crash in late 2025 and sold their AI positions, they missed a 42% rally in the next 6 weeks. The people who bought Apple in 2008 during the financial crisis when everyone said consumer tech was dead, they're up 34,000%. And the investors who bought Amazon in 2000 when everyone declared the internet a worthless bubble, well, they're not reading this script because they're on a yacht somewhere. So here's my question. Why do we keep making the same psychological mistake every single cycle? I'm going to explain exactly where you should be putting your money in 2026, why the current AI panic is creating the single best buying opportunity you'll see in the next decade, and how to build conviction so strong that market corrections don't shake you out of generational wealth. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Look, here's the thing. Most people think investing is about predicting what stocks will do next week or next month. That's not investing. That's gambling with extra steps. Real investing is about building what I call an intelligence factory in your portfolio. Think about it this way. Every company you own is essentially a machine that converts human intelligence and labor into profit. Apple converts engineering intelligence into iPhones. Nvidia converts chip design intelligence into GPUs. Microsoft converts software intelligence into cloud services. But here's where it gets interesting. We're at this inflection point where companies are figuring out how to manufacture intelligence itself. Not just use it, not just optimize it, actually create it from scratch using AI. And when you can manufacture the input that makes every other business more productive, you're not just investing in a company, you're investing in a royalty on the entire economy's future productivity. That's the frame we need to understand 2026. Now, you might be thinking, isn't everyone saying AI is a bubble? Didn't Michael Burry just compare this to 2008? Here's what's actually happening. And this is where most investors completely lose the plot. Burry's argument is that hyperscalers like Amazon, Microsoft, and Google are over-leveraged on AI infrastructure. They're buying chips that they claim will be useful for 5 or 6 years, but Burry thinks those chips will be obsolete in 2 or 3, which means their accounting is wrong, their depreciation schedules are fiction, and when the market realizes this, we get a liquidity crisis similar to the mortgage meltdown. Sounds terrifying, right? Except there's a story that explains why this is completely missing the forest for the trees. Back in 1865, right after the Civil War ended, there was this massive railroad boom in America. Everyone wanted to build railroads. The government was handing out land grants. Investors were throwing money at any company with railroad in the name. And here's what happened. Dozens of railroad companies went bankrupt. The infrastructure spending was insane. Many of those rail lines were barely used for years. By any measure, it was a bubble. Massive overcapacity. Terrible returns for most investors. But you know what else happened? America built the physical infrastructure that enabled every other industry to scale. Steel, agriculture, manufacturing, retail, all of it became possible because someone overbuilt the railroads. The investors who bet on individual railroad companies, many got destroyed. The investors who bet on the businesses that used the railroads, they built dynastic wealth. So when I hear that we're overbuilding AI infrastructure, my first thought isn't fear. It's which businesses will benefit from artificially cheap, overbuilt intelligence infrastructure. Because here's the reality. Even if this current cycle of GPU purchases doesn't generate the returns that Amazon and Microsoft projected in their models, it doesn't matter to you as an investor if you're positioned correctly. What matters is whether we're actually inventing scalable intelligence and whether that intelligence makes the entire economy more productive over the next 20 years. If the answer is yes, and I've spent 3.5 years researching this, the answer is absolutely yes, then every market panic is just a sale on future productivity gains. Let me put some numbers to this so it's not just abstract theory. I have a friend, not a close friend, but someone in my business network who runs a mid-sized law firm. 12 partners, about 40 associates, generates around $18 million in annual revenue. Last year, they started using AI legal research tools and AI-assisted document drafting. Nothing fancy, just Claude and a couple of specialized legal AI platforms. Their associate productivity went up 37%, not 37% happier, 37% more billable work completed in the same amount of time. That translates to an additional $6.6 million in revenue capacity without hiring a single new person. They're not some Silicon Valley unicorn. They're a boring corporate law firm in Cleveland. Now, multiply that story across every knowledge worker profession: accounting, consulting, marketing, software development, financial analysis. We're talking about a $10 to $20 trillion increase in global economic productivity over the next 15 years. And you're worried about whether NVIDIA's H100 chips will be useful for 5 years or 3 years? This is where it gets really interesting, because the psychology of why people miss these opportunities is way more important than the math. There's this concept in behavioral economics called the availability heuristic. Basically, humans overweight recent, vivid information when making decisions. You know what's recent and vivid right now? The dot-com crash, the 2008 financial crisis, the crypto implosion of 2022. Every investor over 35 has been burned by a bubble. So when they hear AI bubble, their brain immediately pattern matches to those traumatic experiences and they sell. But here's the thing they're missing. Those crashes happen because the underlying value proposition was either fictional or decades away from being real. Pets.com in 1999 was trying to ship 40-pound bags of dog food at a loss and calling it a business model. AI in 2026 is already, right now, today, saving Fortune 500 companies billions of dollars in operational costs. One is a fantasy. The other is a functioning profit engine that's only going to get bigger. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Let me show you exactly how this plays out with real numbers, because this is where theory becomes portfolio construction. Let's say you're 42 years old. You've got $450,000 in your 401k, and you're trying to figure out where to put money in 2026. The conventional financial advisor is going to tell you to do a 60-40 portfolio. 60% stocks, 40% bonds, maybe tilt it a little more conservative since you're getting older. That advice was great in 1985 when bonds yielded 14%. In 2026, with bonds yielding 4.2% and inflation running at 3.1%, you're getting a real return of basically 1%. Meanwhile, if you put that same money into a diversified basket of AI infrastructure companies, hyperscalers, and AI-enabled businesses, and we hit even a conservative estimate of the productivity gains I mentioned earlier, you're looking at compound annual returns somewhere between 14 and 19% over the next decade. Let me be specific. $450,000 at 1% real return over 10 years gets you $497,000 in today's purchasing power. $450,000 at 15% over 10 years gets you $1.8 million. That's not get rich quick. That's understanding where the economy is actually moving and positioning your capital accordingly. But you have to have the conviction to not panic sell when the market drops 8%, because some hedge fund manager went on CNBC and said the word bubble. Now, you're probably asking yourself, what about diversification? What if you're wrong? What if AI doesn't play out the way you think? Fair questions. Here's how I think about it. I don't put 100% of my portfolio into AI. That would be stupid. I'm not a gambling addict. But I also don't treat AI like it's some speculative side bet that gets 5% allocation. This is the core thesis. So here's my actual portfolio construction. And I'm going to give you real percentages because vague advice is worthless. 40% in AI infrastructure. That's NVIDIA, AMD, companies building the picks and shovels. 25% in hyperscalers who are using AI to completely restructure their margins. That's Microsoft, Amazon, Google. 20% in AI-enabled businesses that are seeing productivity explosions. Think Adobe, Salesforce. Companies whose products become exponentially more valuable when they have AI built in. 10% in energy infrastructure, because AI needs power. And specifically, I like companies building out nuclear and natural gas capacity. And 5% in boring, cash-flowing businesses that have nothing to do with tech, just to keep me humble. The last 0%? I keep essentially zero allocation in bonds and cash beyond my emergency fund. Because why would I accept 1% real returns when I have conviction in 15% opportunities? But here's where most people screw this up. And this is a mistake I see constantly. They build a portfolio like this, the market drops 12% over 3 weeks, and they panic and sell everything. Then the market recovers, they buy back in at higher prices, and they've just destroyed 5 years of compound returns because they didn't understand their own psychology. So let me tell you how I actually think about market drops, because this is the difference between people who build wealth and people who stay stuck. When my portfolio dropped $3.2 million in a single day last week, my first emotion was not fear, it was curiosity. I immediately started asking why. Is there new information? Did something fundamentally change about the thesis? I started reading. The drop was driven by Michael Burry's fund closure and some narrative about overleverage. I called a friend who's a semiconductor analyst. I read through NVIDIA's last 3 earnings calls. I checked capital expenditure guidance from Amazon and Microsoft. And you know what I found? Nothing had changed. The hyperscalers are still spending. Enterprise AI adoption is still accelerating. The efficiency gains are still real. So I bought more. Not because I'm some genius, because my thesis didn't change, which means the market just put my target companies on sale. There's a story I love about Isaac Newton, and this gets at the psychology of why smart people miss obvious opportunities. Newton was an investor. He bought shares in the South Sea Company early, made a really nice profit, and sold. Then he watched his friends keep making money as the stock went higher and higher and higher. And he kept telling himself, no, it's too expensive now, I missed it. But eventually, the pain of watching other people get rich was too much. So he bought back in at the top. And then, of course, the bubble popped, and he lost essentially his entire fortune. Afterwards, he supposedly said, I can calculate the movement of the stars, but not the madness of men. Which is a very poetic way of saying, I got emotional and made a stupid decision. The lesson isn't don't invest in bubbles. The lesson is don't trade based on FOMO or fear. Trade based on whether the underlying value proposition is real. When the iPhone came out in 2007, I held one in my hand and immediately thought, this is the most transformative piece of consumer technology in my lifetime. Apple's gonna be the biggest company in the world. I didn't need to worry about whether AT&T got a good deal or whether the App Store would work or any of the small details. The big story was so obvious that everything else was noise. That's how I think about AI right now. The details of which chips last, how long are noise. The big story is we're manufacturing intelligence, and that makes everything more productive. Now, here's the uncomfortable truth that nobody wants to say out loud. Most investors fail not because they lack information, but because they lack psychological discipline. I've been running my own businesses for 10 years. I'm surrounded by accountants and lawyers and fiscal advisors. I've learned how money actually moves. And the number one thing that separates people who build wealth from people who stay broke is not intelligence. It's not education. It's the ability to control their emotional response to volatility. You know how many investors sold everything in March 2020 when COVID hit? Millions. You know how many of those investors missed the fastest market recovery in history? All of them. Same thing happened with the DeepSeek panic in late 2025. Same thing is happening right now with the Burry panic. It's the same movie every single time, just with different actors. The plot is always the same. Something scary happens, people panic, they sell, the market recovers, they buy back higher, and they've just paid a massive psychological tax on their wealth building. So let me give you 3 specific tactical things you should be doing in 2026 if you want to actually build wealth instead of just talking about it. First, build a conviction document. This is something I learned from a hedge fund manager I know. Write down right now why you're investing in what you're investing in. Be specific. What would have to change for your thesis to be wrong? Not what would make the stock go down. That's just volatility. What information would fundamentally invalidate your reasoning? Keep that document somewhere you can access it. And the next time the market drops and you're panicking, read it. If nothing in that document has been invalidated, you don't sell. You buy more. This one psychological trick will save you more money than any stock pick I could ever give you. Second, automate your buying so you can't chicken out. Set up automatic investments on a fixed schedule. I don't care if it's weekly, monthly, whatever. The point is to remove your emotions from the decision. Market up, you buy. Market down, you buy. Market sideways, believe it or not, also buy. You're not trying to time the market because you can't. Nobody can. You're trying to consistently accumulate productive assets over time. Lazy investing built more fortune than crypto memes. That's not a joke. That's historical fact. The most successful investor of the last century, Jack Bogle, literally invented the index fund because he realized that doing less, consistently, beats trying to be clever. Third, and this is the one that will actually differentiate you, learn to read the boring documents. I'm talking SEC filings, 10Ks, 10Qs, earnings call transcripts. The information that actually matters is not on Twitter. It's not in some YouTuber's thumbnail. It's in the documents that 99% of investors are too lazy to read. That's where you find out if management is buying or selling their own stock. That's where you find out what they're actually spending money on versus what they tell the media they're spending money on. That's where you find the edge. Not because you're smarter than everyone else, because you're willing to do the boring work that everyone else refuses to do. Here's the thing that trips people up. They think investing is about excitement. It's about finding the next 10-bagger penny stock, or timing the market perfectly, or having some secret information. That's not investing. That's entertainment. Real investing is boring. It's reading 300-page financial documents. It's dollar cost averaging into the same companies every month, even when you don't feel like it. It's watching your portfolio drop 7% and doing absolutely nothing because your thesis hasn't changed. It's boring, and that's exactly why it works. Because everyone else is too busy chasing dopamine hits to do the boring work that actually builds wealth. So here's where we actually are in 2026. We're in the middle of the biggest technological shift since the internet, maybe since electricity. We're teaching computers to think, not to follow instructions, to actually reason and generate novel solutions to problems. And this capability is being deployed across every single industry simultaneously. Healthcare, finance, manufacturing, logistics, entertainment, education, all of it is being restructured around artificially generated intelligence. The companies building this infrastructure, the companies using this infrastructure, and the companies enabling this infrastructure are going to generate absolutely obscene returns over the next 10 to 15 years. And the investors who panic sold because Michael Burry closed his fund, or because the market had a bad week, or because CNBC ran a segment about AI bubbles, those investors are going to spend the next decade watching other people get rich while they sit in treasury bills earning 4%. Your portfolio in 2026 should be heavily weighted toward AI infrastructure, hyperscalers, and AI-enabled productivity plays. You should have conviction based on actual research, not based on what some talking head said on television. You should have a written investment thesis that you can reference when you're panicking. And you should be buying more when everyone else is selling. That's it. That's the entire strategy. It's not complicated. It's just psychologically difficult, which is why most people fail at it. The market's going to keep dropping sometimes. There will be more Michael Burry moments. There will be more scary headlines. None of it matters if the fundamental thesis holds. And the thesis is this: we're manufacturing intelligence. Intelligence makes everything more productive. More productivity means more profit. More profit means higher asset prices. Position accordingly. Don't be the person who understood all of this in 2026 and then panic sold in 2027. Be the person who had conviction, did nothing during the panic, and retired early because you weren't stupid enough to sell the future.